In this session, what we are aiming to cover is a number of accounting standards, in fact, looking at provisions, contingencies from both the liability as well as an asset perspective, as well as events after the reporting period. The relevant accounting standards, if you would like to follow, are IAS 37, IFRIC 1, and IAS 10. When trying to understand IAS 37, it is really important that you revise your conceptual framework definitions. In particular, you should be able to define a liability. That is very important when you're looking at both our contingent liabilities as well as provisions. You need to have a very keen understanding of the various terms that we come across in accounting. It's really going to impact how you go about your ultimate disclosure and recognition. So what do the terms recognition, measurement, and disclosure mean? Okay, so recognition, if we are recognizing something, it ultimately means we're going to have some form of journal entry that is going to record it in our books. Measurement, so if we recognize something, how in fact are we going to measure it? And that measurement can be further subdivided into initial measurement. So how is something brought into our books, at what value? And subsequent measurement. So at year end, is there any considerations that we need to be cognizant of? What do we need to take into account as we measure an item year on year? And then disclosure. So disclosure, we're really talking here about the presentation of the financial statements themselves. So where is this item going to be disclosed in the financials? Will it be in the statement of profit or loss and other comprehensive income? Will it be in the statement of financial position? Will it be a feature in the statement of changes in equity? Okay, so all of these are items that you need to be constantly thinking of as you deal with a particular issue. Looking at provisions, the definition, broadly speaking, of provisions is a liability of uncertain timing or amount. Okay, so we see that this does meet the definition of a liability. So it must in fact be a present obligation. From our knowledge of the definition of a liability, we know that one of the key factors there is that it must be a present obligation. So not a possible obligation, must be at this point in time that we are liable for that particular amount. Now, the issue with provisions is why it falls short of a pure liability disclosure or classification, shall I say, is that it slightly falls short of the recognition criteria. Now, when I'm talking about recognition criteria, we actually apply the old conceptual framework when we look at IAS 37. So you won't be using your new conceptual framework in terms of recognition criteria. In fact, you'll be using the old recognition criteria was that the amount must be reliably measurable, okay? Or the other item, part of the recognition criteria, is that the outflow or the inflow of future economic benefits must be probable. So this is why a provision falls just slightly short of being recognized as a pure liability, because the recognition criteria, there's a little bit of uncertainty there. So it's uncertainty in terms of the timing, okay? So the probability of the outflow or the amount. So the amount might not be reliably measurable. So falling slightly short of the recognition criteria then means we would actually disclose a provision rather than a pure liability. When looking at contingent liabilities, it basically is a type of provision, but there's more uncertainty around that particular transaction. So with your contingent liabilities, they either do not meet the liability definition, so that might mean there's not a present obligation, in fact, there's a possible obligation. Okay, so a provision, there's a present obligation. Contingent liability, there could be a possible obligation, so a higher degree of uncertainty, or it does not meet the recognition criteria. Okay, so there's again an issue in terms of the probability of the outflow of economic benefits or the reliability of that estimate. So if it is very unreliable estimate, or you're actually unable to estimate the value or the amount, then you would find yourself in a scenario where you've now fallen out of the ambit of a provision and now would rather have a contingent liability. We then also have contingent assets. And these again are possible assets. So we don't have a scenario here where it is a hard and fast pure asset. It's a possible asset that may exist. The existence, of course, is still to be confirmed at a future date. Okay, so with your contingent liabilities and your contingent assets, when we spoke about our terms, we said, well, we need to understand, are we going to recognize something and measure it, or are we simply going to disclose it? So with your contingent liabilities and your contingent assets, you're only going to provide disclosure. So you're not actually going to have journal entries for your contingent assets and contingent liabilities. However, with your provision, that are being a liability of uncertain timing or amount, that in fact will be recognized as a form of liability, and you will then journalize a provision in your financial statements. We then have a decision tree, which is a very, very useful tool, especially as you are getting used to these concepts now of a provision, a contingent liability, or whether you need to recognize something or not. Okay, so with this decision tree, it starts off at the top left-hand corner as a liability. Okay, so you recognize that you have some form of liability within the transaction, and then you need to ask yourself, well, is there in fact a present obligation? If yes, you would then lean towards your recognition criteria and say, well, is there a probable outflow of economic benefits? If yes, you then go to the second wind of your recognition criteria and say, well, is that amount reliably estimated? Okay, if yes, you then recognize a pure liability. If we go back a couple of steps to the present obligation where in fact we say no, we could then decide, well, is it a possible obligation? Because we know that if there is a possible obligation, then we are leaning more towards the disclosure of a contingent liability. And so if it's a possible obligation, yes, then we would need to say to ourselves, well, is there a possible outflow of economic benefits? Okay, so if yes, it is possible that there will be an outflow of economic benefits, we then can disclose a contingent liability. And remember, with the contingent liability, that is simply going to be disclosed. So we're just going to write a note up in our financial statements, and there'll be no journal entry for that itself. You look right at the bottom, we have there the recognition of a provision. And that was really in the case of where we have a reliable estimate, but there's a higher degree of uncertainty. Okay, so we've got at the top of the log, recognition of a pure liability. If there is some degree of uncertainty, but we still have a present obligation, we then lean towards recognizing a provision. If there is a very high degree of uncertainty or there's no reliable estimate, we then fall back to a contingent liability where there may be a possible obligation. If there is no possible obligation, then we're simply going to ignore that because ultimately it's highly unlikely and it's not something that's going to affect our decisions. We can't simply go about disclosing and listing items that aren't even a possible obligation for our company. That just doesn't make sense. Again, with the possible outflow, if it is highly remote that there's going to be an outflow as a result of that transaction, then again, you would simply ignore that transaction. It wouldn't need to be disclosed because of the very, very high degree of uncertainty or probability that it won't actually happen. So when looking at this decision tree, it's always important that you look at the options within that decision tree. You can then highlight and follow it, which will help you just trigger the way that you need to start thinking about these types of transaction. We've also got some tutorial tips here. So first tip is to expand this diagram to assist you in answering the discussion type questions. It's really, really helpful because it just gets your mind used to the thought process that you should be taking when ultimately making the decision on whether you have a pure liability or provision or contingent liability. The second tip we have for you is to try to discuss your answers with your friends as well. So of course, with the pandemic, we can't do that face to face, but set up a WhatsApp group, do a little Zoom session with your friends. It's always very helpful to discuss these types of questions and solutions because it helps you to generate ideas and to discuss different viewpoints. Okay, so also very important to revise your conceptual framework definitions, as we said in our very, very first startup of the session. It's important that you look at the question as to whether you should be using the old conceptual framework or the new conceptual framework. So if the required states that you must discuss in terms of, say, ICE 37, then we know we need to apply the old conceptual framework in terms of the liability definition as well as the recognition criteria. If you're required to discuss in terms of the conceptual framework, so if that's what the required states as being part of your question, discuss in terms of the conceptual framework, then you'd be expected to apply the new definitions and the new recognition criteria. Some of the definitions we are going to be able to apply as a result of having gone through this particular chapter from GRIP and GARP is we should be able to define a provision, so a liability of uncertain timing of an amount. The liability definition in terms of the old conceptual framework. We'll want to be looking at an obligating event. That's going to be particularly important when we are discussing the very, very first and overarching criteria of a liability being, is there a present obligation? We're going to need to take a step back sometimes and say, well, what in fact was the obligating event? There may be a legal obligation or constructive obligation. So different types of present obligations can either be from a legal standpoint, so perhaps there was a court case and it has been ruled against the business, or constructive obligation. So this means it's not a legal court case or binding decision from a judge, but in fact there is perhaps some pattern of established past practices, or there could be some form of announcement that's been made and expectations have thus been created. Contingent liability and a contingent asset, as we said, just falls short of the pure liability and asset definitions because here we have a higher degree of uncertainty. We'll also look at what is an onerous contract. So this is generally a contract where you probably don't want to continue to fulfill it and you need to make a decision. Will it be cheaper for the business to simply cancel and incur penalties to get out of the contract, or is it actually cheaper just to continue until the end of the contract? As well as restructuring. Restructuring is going to become more and more topical as businesses close down and are experiencing significant hardships as a result of the COVID-19 pandemic. So that is definitely going to be a topical item that you should pay attention to. When looking at our recognition of a liability in terms of provisions, remember we said from the viewpoint of ICE 37, it has not yet been updated for the new conceptual framework. So we do need to continue using it as it is written in the accounting standards. Okay, so everything that we do is governed by the accounting standards itself, and ICE 37 is still applying the old conceptual framework. So we would use our old liability definition. The most important or challenging part in terms of our liability definition is trying to decide, is there in fact a present obligation? And we said we're going to look in that in a little bit more detail and say, well, what in fact is the obligating event? And then also what type of obligation are we looking at? Is it perhaps a legal or constructive obligation? We then need to take things a step further with provisions and look at our recognition criteria as well. So remember, our old recognition criteria are 2 items that must be satisfied. Firstly, the amount of the obligation must be reliably measurable, and the outflow of the future economic benefits must be probable. Okay, so it is very important that you understand the ethos of the recognition criteria itself, the amount of the obligation being reliably measurable. So you should be able to say, is this a reliable estimate, or is this actually something that draws back to an invoice or a bank statement? That's what would make it reliable, is perhaps if there's a source document that really validates that amount, or there is someone who is an expert or a financial manager who is able to provide a reliable estimate on what that amount would be based on their significant experience within the business. The outflow of economic benefits being probable. So it's not enough to just say, yes, they're going to pay this money as a result of the court case. Okay, it must be probable that they are going to pay out the money. So that is the important word within the second recognition criteria, is that the outflow must be probable. So more likely than not, they are going to pay over this money. And that could be because it is a legally binding decision, you know, that they'll be forced to pay it, even if they chose not to. That would then make it probable that there will be this outflow of money or economic benefits from the entity itself. And just a reminder of our definition of a provision, so we don't lose focus here. As a provision is a liability, so liability definition from the old conceptual framework, of uncertain timing, so we don't know exactly when it's going to happen. There's uncertainty in terms of the timing or the amount. Okay, so the amount might be an estimate, so it doesn't mean it's not reliably measurable, but it means that there's some degree of uncertainty around the amount. So it may be, in fact, an estimate or an average of values that are available in terms of the information. Both a pure liability as well as a provision are shown on the statement of financial position, but it's very importantly shown that they are separately disclosed. Okay, so you shouldn't be including a loan and a provision together as one liability on the face of the statement of financial position. In fact, must be shown separately, because at the crux of it, so right at the base of it, is they are different in terms of their nature. A provision and a liability are different, and we can see that different in the definition of a provision being a liability of uncertain timing or amount. So a higher degree of uncertainty as with a pure liability. When we look at a present obligation, which we said is very, very important in terms of our definition of a liability, which ultimately filters into our definition of a provision. We said that for there to be a present obligation, there's basically got to be two things that have taken place. There needs to be some form of past event, and there must be an obligation attached to that event, which is defined as our obligating event. One of these very useful tools when you're trying to decide, do I in fact have a present obligation, is to perform a walk-away test. So you can ask yourself that if in fact this business closed today, would they still have the obligation as a result of that transaction? And that's going to help you to determine, well, yes, if they close down, they're still going to have to pay X, Y, Z. Therefore, it is in fact a present obligation. So it just helps to make it a little bit easier when determining a transaction in terms of your decisions. When looking at the present obligation, we really said that where there is a degree of uncertainty, but it's still more probable than not, we then would want to recognize a provision. So greater than 50% chance that that present obligation exists at your end, we would lean more towards the definition of a provision being satisfied. When there is a very high degree of uncertainty, so less than 50% chance that there is even a present obligation, then we would want to look at whether we possibly have a contingent liability, which we said we do not journalize, we only provide disclosure, or if in fact it's so remote in terms of the possible outflow of economic benefits that you would simply need to ignore that transaction and you wouldn't even disclose that information in the financial statements. How do you make this determination on whether we have a provision or contingent liability, or if we simply ignore the transaction? You need to make sure that you apply your professional judgment. You may need to possibly consult with experts, and you may even use any information that is brought to light after the reporting date, which can help you to give more information on what actually transpired and in terms of the probability of that present obligation existing. When looking at a past event, we said that what is important here is that the event must have occurred on or before year end. Okay, so that is important for that past event to be relevant to the current set of financial statements, is that event must have taken place on or before reporting period. Okay, so you're going to see this coming through in a number of different questions, and you mustn't have it confuse you. Always looking for that past event and when did that actually take place. For the past event to lead to an obligation, that past event must be an obligating event. Okay, so this past event must leave the entity with some form of obligation as a result of it taking place. The definition of an obligating event is one that leaves the entity with no alternative but to settle the liability. Okay, so again, we're really focusing on this ethos of that walkaway test. We're really saying to ourselves, well, if the business closed down today, would they in fact still have the present obligation? The obligating event, or that obligation itself, it exists independently of the entity's future actions. So no matter what the entity chooses to do going forward, it's not going to change the result of that obligation itself. And the obligating event always involves a third party, so someone external to the business itself. We're now going to look at our first example from your Gripping GARP textbook. And this example says to us to consider the following issues that were discussed during a directors meeting on the 24th of December 20X3. When we look at the required, they ask us to explain whether or not the above result in present obligations at the 31st of December 20X3. So as we can see, this directors meeting takes place approximately 6-7 days, a week before the financial year end. And the 4 scenarios that ask us to consider are, firstly, scenario A decision was made by the directors to pay a bonus to an employee. So now looking at the scenario, with the decision that was made by the directors to pay a bonus, they haven't in fact told the employee anything. Okay, so we can't say we have a constructed obligation because in fact, we've not made any form of announcement to the employee. There's no expectation on behalf of the employee. So the directors have made this discussion, they've had this decision behind closed doors. So there's no valid expectation or obligation yet. Is there a legal obligation? Well, they haven't signed anything with the employee. So again, there's no form of a written agreement between the directors or the company and the employee. So for scenario A, there's no legal or constructive obligation to pay the bonus because it's not yet communicated to the employee. So there is no valid expectation that has been created. So in the first scenario, we do not have an obligating event. Let's look at the second scenario. So scenario B tells us a decision was made by the directors to purchase a new machine in 3 years' time. Okay, so a decision made to purchase a machine in 3 years' time. Have we approached the supplier yet and told them we want to buy a machine? Okay, no, we haven't approached them yet. We've made the decision behind closed doors. So there's no constructive obligation yet. Have we made any formal written offer to purchase the machine from our supplier? Okay, no, we have not. So again, there's no legal obligation as a result of this decision. Okay, so there's no legal nor constructive obligation to purchase the asset because in fact we've not yet ordered from our suppliers, so we don't have any expectation. Okay, so also remember that we have just made a decision, but there's been no communication in terms of the new machine itself. When we look at scenario C, it tells us that the legislation recently passed means that one of the plants has to be dismantled in a year's time. Okay, so now there's been legislation, so laws being passed that one of the plants that we already have in our possession has to be dismantled in a year's time. Okay, so we've already got the plants. Now legislation has been passed that in a year's time, we're going to have to dismantle that plant. So what would happen if, in fact, we closed our doors today? If we performed our walkaway test, close our door today, would we still have to incur the cost to dismantle the plant? Yes, we would. Okay, we would not be able to avoid that obligation to pay for the plant to be dismantled. Okay, so because of the new legislation was now brought into effect, but we already owned the plant that was going to incur these dismantling costs. These costs are in fact unavoidable. Okay, so when we then look at the last scenario, scenario D, it tells us that future losses are expected from a branch in Botswana. Okay, so future losses, okay, remember that one of the requirements in terms of there being an obligating event is it must be a third party and it must be unavoidable. Are future losses avoidable? Okay, remember these future losses are expected from a branch in Botswana, but there definitely could be actions taken by the entity itself to avoid those future losses. Yeah, they could change their strategy. They could put in place a number of different elements to make sure that they avoid those future losses. Okay, so because they can in fact be avoided, that would mean that there's not an obligating event. What is nice that they included in the solution here was the fact that there is an indication of possible impairments. So when we're looking at different scenarios, it's important that we don't just look at it in isolation from this particular topic point of view. We should be able to bring in all our knowledge and apply it to any transaction that is brought before us. Okay, so if there's a possibility in terms of future losses, maybe that branch needs to be closed down, maybe there are impairments that relate to that particular branch that need to be considered. When we look at our second example from your Gripping GARP textbook, it tells us that Damage Limited owned a road tanker that overturned in December 2023 during a bad rainstorm. The tanker spilled its contents, thus contaminating a local river. Damage has never before contaminated a river. Damage has no legal obligation to clean the river. They've also got no published policies as to its views on the rehabilitation of the environment and has not made any public statement that it will clean the river. It intends to clean up the river and has been able to calculate a reliable estimate of the cost thereof. You're required to explain whether damage should recognize a liability or provision at 31st of December 2023. And so when we look at our event, we firstly need to understand, well, the event itself, is it based on a past event? Okay, so yes, the content spilled into the river and it happens prior to year end. So we do have a valid past event. But did that past event give rise to an obligation? So is this in fact an obligating event? When we look at the potential obligation, we want to say, well, is there a legal obligation or a constructive obligation? So there's no law that requires them to clean up the river. So in fact, there's no legal obligation. Is there a constructive obligation? So is there an established past practice or have they made some form of announcement? Okay, so no, that is not satisfied. Therefore, we do not have an obligation. There's no legal obligation, no constructive obligation. There is no obligation. Therefore, we do not have a liability or provision. Ultimately, the entity can still change their intention. Even though they say they intend on cleaning up the river and providing for rehabilitation, they're not bound to that. They can still change their intention, and thus we don't have any obligating events. When looking at our recognition criteria, just to remind ourselves, we really said we are applying the old conceptual framework, and we look at two overarching criteria in terms of recognition. The first one being that there's a probable outflow of future economic benefits, and the second one is that that amount is reliably estimated. When looking at the probability of outflow, if it's more than likely to occur than not occur, then we would recognize a liability as a provision. Okay, so we would recognize a provision where it is more than likely to occur than not occur, so more than 50%. Where it's more likely that the outflow will not occur, then we might want to look at a contingent liability being disclosed. If the probability of outflow of future economic benefits is remote, so there's hardly any chance of it even happening, then we simply ignore that transaction. We do not disclose it, and we do not journalize it. Remember, provision, we journalize and disclose. Contingent liability, we only disclose. There's no journals. If it's remote, we simply ignore. That means we do not journalize and we do not disclose. The amount is reliably estimated. If the estimated amount of the obligation involves a larger degree of uncertainty than normal, then the liability is recognized as a provision. Okay, so all we can see with the recognition criteria is where there is a degree of uncertainty, then we typically move from a pure liability to a provision. Where there is even higher degree of uncertainty, we then move from provision to a contingent liability. If it's highly unlikely that it's even going to happen, it's remote, we therefore ignore it. When a liability is based on an estimate as opposed to a definite amount, we're going to lean towards a provision. Okay, so provision is estimated, definite amount, more towards the side of a liability. If the amount is so uncertain and the estimate is so unreliable, then we move from a provision and we downgrade it essentially to a contingent liability. And so like we've tried to emphasize throughout this presentation, that contingent liabilities are not recognized, they are only disclosed. Why am I saying they're not recognized? Because we do not provide any set of journals for our contingent liabilities. They're disclosed where we're going to provide them some written information in terms of the contingent liability in the notes to the financial statements. Why are they not recognized? They can't be recognized because they fall short of either the definition or the recognition criteria. Remember, when we go back to our conceptual framework, when we go back to the basics of accounting, we know that we can only recognize or journalize an item if it meets both the definition and the recognition criteria. So contingent liabilities fall short of one of those two elements, and therefore we cannot recognize them. We can only provide for disclosure. We're now going to look at our next example from your Grip and GOP textbook. Example 3 says to us that a company sells goods with a refund policy. If the customer is not satisfied, the goods may be returned for the full refund. Sales for the year came to 100,000 Rand. You are required for each of the following scenarios to explain if there is a liability, a provision, or a contingent liability at year end. First scenario, scenario A, at year end, it is reliably estimated that only 5% of sales will be returned for a full refund. Scenario B, at year end, it is not possible to estimate the possible returns and related refunds. And so looking at scenario A, we do have a reliable estimate that 5% of sales will be returned for a full refund. So we know that immediately we do have a form of obligation. Is it a legal obligation? Yes, you more than likely have some form of policy that is drawn up that customers are aware of, or it's included within the sales contract with the customers itself. So you do have an obligation to provide that refund. Is there a constructive obligation? Yes, there's a past established practice and pattern of this entity giving refunds to the customers. What is in fact our past event? Our past event is the sale of the goods taking place before year end. So because it happened before year end, it is relevant. Is there a present obligation that exists? Yes, we said there's both a legal and a constructive element in terms of a present obligation. When we look at our recognition criteria, we say to ourselves, well, is there a probable outflow of economic benefits? Yes, there is past experience where we can reasonably expect that 5% of those sales will ultimately be refunded. Is the amount reliably estimated? Yes, again, you've got this established past experience. It's reliably estimated at 5% of the 100,000 Rand that was sold. So we can reasonably expect 5,000 Rand will be provided in the form of a refund. Why is this not a pure liability? Is this 5,000 Rand done, set in stone, trace it to an invoice or a bank statement? No. There is some uncertainty. It's definitely not going to be exactly 5,000 Rand in terms of the refunds. There is some uncertainty, but it's more than likely going to happen that it'll be around that value. But there is some element of uncertainty in terms of the amount and the timing. Therefore, it falls within the definition of a provision. Remember our definition of a provision. As a reminder, it's a liability. So we said it is a liability because there's a present obligation of uncertain timing or amount. So we said we can estimate it to be 5,000 Rand, but it's definitely not going to be exactly refunds of 5,000 Rand. Okay, so there is some form of estimation. There is some degree of uncertainty, but it is still more probable that it is going to happen. When we look at scenario B, remember in scenario B, we had no estimation available. So it's same as that of scenario A, except the amount that is being not reliably measurable. And so no liability can be recognized because we are not able to give an actual figure. There is a higher degree of uncertainty in terms of that value. We can in fact provide a contingent liability that's disclosed in the note to the financial statements. Okay, so because of the very high degree of uncertainty and the inability to provide a reliable estimate, we can no longer have the definition of a provision being applied. We now need to go to the next level and look at a contingent liability being disclosed. When we look at the measurements of provisions, like we saw in this previous example, they had some form of estimated probability of 5% of the value being refunded. So they can use an expected value of the obligation, looking at possible outcomes multiplied by the estimated probabilities to get a reasonable figure that would be expected to be incurred going forward. There's often going to be a lot of judgments involved in determining what that amount is going to be. You might want to look at best estimates and expected values. So they might say best case scenario, expected scenario, and worst case scenario. And you might need to average that out to get what the expected value would be. Any risks and uncertainties must be taken into account when you are providing for this value. You might also want to look at future cash flows and discount to a present value due to the time value of money, which you've already covered when you went through PP&E and inventory, all those types of sections, where you said you're going to pay perhaps a certain value in a few years' time, and you discounted it using your effective interest rate to a present value. So looking at our measurement. So our measurement is the amount that one would rationally pay to settle a liability at year end. So this is ultimately what we are striving towards when we are trying to determine what is the value we should be recognizing in the financial statements. The best estimate is based on a number of different things. So ultimately, management's professional judgment. Often they've been involved in the entity for a number of years. They know what to expect. They know how the business operates. They know what's happened in terms of the history of the business. and they would be able to exercise a professional judgment on what would be the best estimates. Any previous experience with similar transactions that will help to guide on what would be expected to take place in the current scenario. You may also consult in terms of independent expert advice. Okay, so if it is something very complicated, you might even need an actuary to come in and do the calculations to get you that best estimate. And then you'd also want to look at information that comes to light after the reporting period. Now, just because something happens or information comes to light after the reporting period doesn't mean it's irrelevant. It might give you more information regarding something that happened before year end. Okay, so it's not something that needs to be discounted completely. Often events after the reporting period give you more information about things that took place before year end and can still be relevant. You want to weigh the outcomes based on probabilities. So you've done statistics. Note that the probabilities can be used to help determine your reliable estimates. And your risks and uncertainties of events or circumstances may cause you to, in fact, adjust that amount. Now, that's something you're actually going to cover in IS 8 when you look at changes in estimates. But we do include it here, and it's definitely something you want to come back to after you've done IS 8. We're going to look at our next example, which is example 4 from your Gripping Gob textbook, and it says to us, an entity offers goods for sale with a 6-month warranty where goods that are sold but found to be faulty within 6 months after sale may be returned for a full refund. Not all goods will be faulty, and similarly, not all customers will bother to return faulty goods. The entity's past experience suggests that the following are the possible outcomes and the probability thereof. I'll show you on the next slide the possible outcomes and the probability. You're required to calculate the expected costs of the provision and to journalize. Okay, so here we've got the outcomes. There's a 70% probability that people are not going to return the goods. There's a 30% probability that they will return the goods. Okay, so now the 70% that are not going to return, do we want to provide anything for that? Okay, no, we're not going to have to refund them. So it's not going to be something that we're interested in. What we are interested in is in the 30% probability that they will return goods. Because for them, we need to decide, are we in fact going to provide for that refund that we're going to provide for them? Okay, so the estimated cost is at 100,000 Rand to refund, and the probability is 30%. So we simply take the probability of 30% times by the estimated cost of 100,000 Rand, gives us 30,000 Rand expected value of the obligation. Now to journalize that, we debit the warranty cost. So the cost of actually, in fact, providing this warranty to the customers, debit warranty costs, that would be an expense, 30,000 Rand. Credit the provision for warranty costs, 30,000 Rand. Why are we saying provision? Is it a liability? Yes, there is a present obligation. We sold this goods before year end. That's our obligating event. And we do, in fact, have a legal obligation if it's an established policy or included in the sales contract with the customer. Also a constructive obligation because it is already something that we do based on past practices. So we do provide for the return of goods to from customers. Okay, so now that we've established that, it is a liability, is the uncertainty in terms of the timing or the amount. Yes, we've had to estimate the refund amount to be 30,000 Rand. We do not know what that exact value is going to be. We simply can provide our best estimate available from the information. When we look at the next the next example, shall I say example 5, it says to us that on the 1st of January 20X1, an event occurs that results in an obligation to pay 100,000 Rand at 31st December 20X3. This is duly paid on the 31st of December 20X3. The present values of this obligation have been calculated as follows. Okay, we're then given the present values the very, very first day, 60,000. The end of that first financial year, 70,000. The end of the following financial year, 90,000. And the end of X3, the final future value of 100,000 Rand. You're required to show the related journal entries for each of the 3 years. Now, just understanding this as it sits, the present value, the 1st of January 20X1 is 60,000 Rand. The future value of that same 60,000 Rand at the end of December 20X3 is 100,000 Rand. So why is there a difference between the present value of 60,000 Rand and the future value of 100,000 Rand? Ultimately, that means 40,000 Rand is what is deemed implicit interest. Okay, so that really is made up of the difference between our present value of 60,000 and our future value of 100,000. Ultimately, we expect 40,000 Rand to be recorded as a form of interest. And so let's journalize this over the 3 financial years. And what we would want to probably start off with is a table. So you might want to do an effective interest rate table, starting off with your present value on the very first day of January X1 of 60,000 to then get your closing liability of 60,000. You would then need to add 10,000 interest to get from 60,000 to 70,000. Then to get from 70,000 to 90,000, you need to add 20,000 Rand of interest. And then to get from 90,000 to 100,000, you need to add 10,000 of interest, which would then give you your full value of 40,000 interest over the 3 financial years. And so let's follow from the very first day that we would journalize this item. So we would debit either the expense or the asset and credit the liability at the present value on the 1st of Jan 20X1, which is 60,000 Rand. We then said that at the end of X1, the correct present value now for that liability would be 70,000 Rand. So ultimately, that means that 10,000 Rand would be incurred for interest for the first financial year. Debit our interest expense, remember that goes directly to profit or loss, 10,000 Rand, and credit our liability. We've now updated our liability by 10,000 Rand. So we started off on the 1st of Jan 20X1 with our liability at 60,000 Rand. We then added interest to that liability of 10,000 Rand at the end of X1, which now means the amount sitting in our liability is correctly updated to 70,000 Rand at the end of X1. We then look at our next financial year, 31st of December 20X2, and we said now the liability is actually sitting at a value of 90,000 Rand. So our liability, we updated to a value of 70,000 Rand. It's now sitting at a value of 90,000 Rand, which ultimately means in 20X2, interest of 20,000 Rand was actually incurred. The debit interest expense, 20,000 Rand, credit our liability with 20,000 Rand. We've now updated our liability. If we look at our first journal entry, 60,000 for our liability. Second journal entry, we added 10,000. So we're sitting at 70,000 Rand. End of X2, we added another 20,000. It's now sitting at 90,000 Rand. So then at the end of X3, how are we going to get from 90,000 Rand to 100,000 Rand? We're ultimately incurring another 10,000 Rand interest for 31st of December 20X3. Debit our interest expense with 10,000, credit our liability with 10,000. Our liability is now updated to the future value of 100,000 Rand, and now we're in fact going to settle that liability. How do we reduce the liability? We debit it with 100,000 Rand, and we are settling that liability, so we are crediting bank. We are paying out that money of 100,000 Rand. When looking at our next example, example 6, a factory plant is bought on the 1st of Jan 20X1. The cost is 450,000 Rand cash, including installation. We are obliged to decommission plant after 3 years. The discount rate is in fact 10%, and the effect of discounting is considered immaterial. Depreciation is estimated on the plant using straight line method to a nil residual value. And you're required to prepare the present value table, as well as the related journal entries. Okay, so here we can see we've got a factory that is cost 450,000 Rand cash, and we need to decommission that plant after 3 years. Okay, so how do we need to account for this? So that value in 3 years' time to decommission the plant is going to cost 399,300 Rand. So that at the bottom of our slide here will be represented by our future value. So we're going to incur costs of 399,300 Rand in 3 years' time to decommission the plant. So if that's our future value in 3 years' time, we want to know what is our present value today. So we take that future value and we divide it by 1.1. Why are we using 1.1? That's because in the question they told us that the discount rate is 10%. So it will be 1.1 because 10% is 0.1. 1 plus 0.1 is 1.1. So what if the discount rate was 15%? Then it would be 1.15. Okay, so hopefully you understand how the mechanics of that works. And then why have I said it's divided by 1.1 to the power of 3? That's because it's going to be paid in 3 years' time. Okay, so that value will be in the number of years' time in the future. That then gives us our present value, which is 300,000 Rand. We can now start populating our table. We start off on the 1st of Jan X1 with our opening balance at the present value of 300,000 Rand. We take 300,000 Rand times by 10% gives us our interest, 30,000 Rand. We take our opening balance of 300,000 plus the interest of 30,000 gives us our closing liability of 330,000 Rand. The closing becomes your opening. We then need to account for interest, so 330,000 times by 10% gives us our interest of 33,000 Rand. Our opening balance of 330,000 Rand plus the interest of 33,000 Rand gives us a closing balance of 363,000 Rand. That closing balance then becomes our opening balance at the end of X2. We account for our interest at 10% of 363,000 Rand, which gives us interest of 36,300 Rand. We add our opening balance of 336,000 Rand plus our interest of 36,300 Rand to give us our closing liability of 399,300 Rand. Now, as you can see, that actually relates back to our question where the future value was going to be 399,300 Rand in 3 years' time. So we started off with our opening balance on the 1st of Jan 20X1 at 300,000 Rand, and we ended up in 3 years' time at 399,300 Rand. And when looking at our plant cost and bank, so the very, very first day when we're in fact purchasing this plant, we debit plant costs with 450,000 Rand and we credit bank with 450,000 Rand. We then debit plant decommissioning costs with 300,000 Rand. And that would be deemed as a type of asset. It would form part of the plant in the PPE line item in our statement of financial position. And we credit our decommissioning liability at 300,000 Rand. We debit our interest expense, okay, for profit or loss, 30,000 Rand. And that was taken directly from our table. So the very, very first line of interest, 30,000 Rand. And we then credit our decommissioning liability with 30,000 Rand. So as we can see, in our very second journal entry, we credited the decommissioning liability with 300,000 Rand. And then in our third journal entry, we credited it with 30,000 Rand. So it's now sitting at the end of the first financial year at 330,000 Rand. We then now reach the end of the financial year, so we must account for our depreciation on our plant. Remember, we said the plant is made up of both the cost of 450,000 plus in our second journal entry, it's also made up of that decommissioning value of 300,000 Rand. That ultimately means the plant value is 750,000 Rand divided by 3 years, which means depreciation will be annually 250,000 Rand. If we look at our next financial year, and we now need to account for our interest, so debit the interest expense, credit the decommissioning liability with 33,000 Rand. Okay, that's taken directly from our table. So second row there is 33,000 Rand in terms of interest. We then account for our depreciation, which we know is 250,000 Rand per year. We then reach the end of the third year, and we now can account for the final year of interest. So the third row there in our table, we account for our interest at 36,300. So that's taken right there, the first journal entry under the 31st of December 20x3. We account for our interest at 36,300. We must not forget our depreciation of 250,000. We do need to take it one step further because it is now the end of 3 years, and we now are going to, in fact, settle that decommissioning liability. So debit the decommissioning liability at the full 399,300 Rand and the outflow of payment by crediting bank with the same value. We look at our next example from the Grip and Go Up textbook, which is example 7. And in this example, it says to us that a company owns a number of nuclear plants. The company is presently obliged to dismantle one of these plants in 3 years' time. The last nuclear plant dismantled by the company costs 1 million Rand to dismantle, but the company expects to dismantle this nuclear plant using the same technology at a slightly reduced cost of 800,000 Rand due to the increased experience. There is also a chance that completely new technology may be available at the time of dismantling, which could lead to a further 200,000 Rand cost saving. We are now to discuss the measurement of the provision for the dismantling of this nuclear plant. So when looking at a provision, it reflects future events if there is sufficient objective evidence that these events are going to occur. Okay, so no, it can't be a belief, it can't be a I think. It's got to be sufficient objective evidence for us to actually take that into account when measuring our provision. Any expected cost savings due to past experience is reasonably expected to occur. Your expected cost savings due to a chance of new technology becoming available is outside of your control of the company itself, and so it shouldn't be taken into account unless there's going to be the sufficient objective evidence that it is in fact going to be available when you go round to providing for the dismantling. So the provision, in fact, in this case should be measured at 800,000 Rand, and we also need to take into account any present valuing as a result of this being a future value. Okay, so like we said, the increased experience, that in fact could be included or taken into account, but the technology that there's a chance of definitely is too remote for us to actually consider, and it does not provide enough sufficient objective evidence for us to include that when making our estimate. Now, looking at something that is quite topical is the notion of a provision. So do we have provision for doubtful debts? So it's something that's quite topical, so we have included it within our slides. But most accountants are familiar with the naming convention we use of provision for doubtful debts. And that really used to signify the allowance account used to account for bad debts allowances on our trade receivables. So deducted directly off of that trade receivables value at the end of the financial year. So we know that that is ultimately used to reduce the carrying amounts of trade receivables that is shown in our statement of financial position. And really, why are we reducing our trade receivables? Because there's some form of doubt regarding whether we're actually going to collect that value from our debtors, in essence. So this naming convention might not technically be accurate because is it in fact a provision for doubtful debts? And so we know that our definition of provision is, in fact, it's a liability of uncertain timing or amount. A liability is some sort of present obligation from the entity itself arising from past events, the settlement of which is expected to result in an outflow of resources. So when we think of doubtful debts on trade receivables, we don't have an obligation to pay anything out. There's no expectation that we're going to have an outflow of resources as a result of trade receivables not paying. In fact, we're just expecting there not to be an inflow of resources. So in fact, really what we're experiencing is a form of impairment on your trade receivables rather than what would be technically called a provision. Okay, so the term there that should correctly be used is an allowance for doubtful debts or your impairment on credit losses. So definitely you should not be using the term provision for doubtful debts. So that is technically incorrect. We're looking at gains on disposals of assets. So we know that assets need to be sold in order to meet obligations sometimes. Ultimately, when we make sales of inventory, that's a type of asset that we're selling to generate cash flow for the business to meet the obligations. These must be viewed as separate economic events. Any gain on an asset must not be taken into account when calculating provision. Okay, so these must be kept independently from each other. They can't be offset or shown at a net value. When we look at this in terms of an example 8 from your Gripping Garb textbook says that new legislation means that Undo Limited must dismantle its nuclear plant in a year's time. The dismantling is estimated to cost 300,000 Rand, and they expect to earn income from the sale of scrap metal of 100,000 Rand. The effects of discounting are expected to be immaterial, so that means we don't need to present value. You're required to process the journal entry to raise the provision for these dismantling costs. So now the question here is, it's going to cost us 300,000 Rand to dismantle, but we're going to earn income from the sale of the scrap as a result of dismantling at 100,000 Rand. So does that mean I can just raise a provision of 200,000 Rand because that's all it's going to actually cost me to dismantle? Okay, the rules tell us no. We must show the provision of 300,000 and the asset or the gain of 100,000 separately. Okay, so the solution, we debit our nuclear plant dismantling cost, 300,000 Rand, and we created the provision for dismantling costs at the full value of 300,000 Rand. So we do not net off that 100,000 Rand we expect to receive as a result of the sale of scrap metal. When looking at reimbursement, so this is something that happens quite often in terms of retailers, where they're really a middleman between a manufacturer and a customer themselves. We know that the entity's obligation to the customer would form a liability. So where you're going to refund the customer, you would incur a liability there. But then you're going to get a reimbursement from the manufacturer, which would be an asset. Now, what does a reimbursement mean? It means that the customer has brought perhaps a faulty product to you as the retailer. Okay, you have then refunded the customer. You then have said to the manufacturer, right, I've refunded the customer from your faulty product, and they're going to reimburse you. So they're going to pay you back the amount that you in fact refunded the customer. They're reimbursing you. Okay, so two elements to this where the retailer is the middleman, where you're paying the customer, being a liability, it's a refund, and then you're getting money back from the manufacturer, being an asset. So the asset, again, must be disclosed separately. We just saw this in the previous example. You don't want to offset these two transactions, the one with the customer and the one with the manufacturer. You need to disclose those separately. The asset is only recognized if it's virtually certain. So it's not like with liability where we say virtually certain, pure liability. There's some uncertainty, provision. There's quite a bit of uncertainty, contingent liability. With an asset, there isn't those degrees of uncertainty. It needs to be virtually certain that we can recognize the asset itself. And it cannot be measured more than the amount of the provision. So if you're refunding the customer 100,000 Rand, you can't have a reimbursement of 105,000 Rand. okay, it can't be more than what you're in fact going to refund the customer itself. The asset and the liability we cannot set off. They must be shown separately. However, the income and expense may be set off. So you would want to go back to your offsetting criteria and just make sure that that is able to be set off. But generally, your income and expenses under these types of scenarios can be set off from one another, but the asset and liability must be shown separately. Where the reimbursement from a manufacturer is not virtually certain, then we would have a possible contingent asset, which again is not going to be recognized. It's only going to be disclosed in the note to the financial statements. So here's a nice graphical representation of the retailer itself being that middleman. Ultimately, the manufacturer is selling goods to us, the retailer, and they're also going to offer a guarantee from the manufacturer itself to say that if the customer needs a refund, we're going to reimburse you. The guarantee that we offer the customer as the retailer is what is ultimately going to be our refund liability. The guarantee we're receiving from the manufacturer itself would be deemed as a reimbursement in the form of an asset. And we said this liability and asset cannot be offset from one another. Here's a little graphical representation where we are perhaps Game, we're the retailer, Game stores, and Sony the manufacturer. And we're now going to apply this information in terms of an example from our Grip and Garp textbook. We're looking at example 9. This example says to us that a retailer sells goods to its customers that are guaranteed. You're required to state whether the retailer must raise a provision for the cost of meeting the future guarantee obligations if, first scenario, the retailer provides the guarantee. If the retailer provides the guarantee, yes, they're going to have an obligation to fulfill that guarantee, and they definitely must, in fact, raise a provision. In the second scenario, the manufacturer provides the guarantee and the retailer is not liable. If we're not liable, then we do not have any sort of obligation as the retailer, and therefore we will not provide for any type of provision. The next scenario says the manufacturer provides the guarantee, but the retailer provides the guarantee irrespective whether the manufacturer honors it. So yes, then in that case, the retailer has to raise a provision because we're definitely the ones who are obligated here in this scenario. And where it is virtually certain that the manufacturer is going to reimburse us for that guarantee, we will raise also a reimbursement asset. In scenario D, the manufacturer and the retailer provide a joint guarantee, and they're ultimately going to be jointly and severally liable and share the costs. So that means for the retailer's portion, you would want to provide a provision. But for the manufacturer's portion, you might want to provide a contingent liability and say, well, you know, if the manufacturer for some reason falls short on their side of the obligation, we might have to carry a bit of the burden here. Whereas this now differs from scenario E that says the manufacturer and retailer provide joint guarantees, so similar to above. But in scenario E, the retailer is not liable for the manufacturer portion. So where they're not reliable for that portion, it's going to be similar to part D, where we said the retailer portion we raise as a provision. So that will remain the same. But what's different here is for the manufacturer portion, we'll actually not recognize it in scenario E because ultimately we're not going to be liable for their portion of the guarantee. So there's going to be no terms of recognition of that in scenario E. Looking at our next example, example 10 says that a retailer offers guarantees to its customers and it estimates that it will cost 100,000 Rand to fulfill its obligation in respect of the guarantees. And the supplier, however, offers a guarantee to the retailer company. You're required to show all the related journals and disclosure in the statement of financial position, assuming that under scenario A, the entire 100,000 is virtually certain of being received from the supplier, and then B, an amount of 120,000 Rand is virtually certain of being received from the supplier. Okay, so we're really testing the principle here that what value will we be raising the provision at? So we estimate that it will cost 100,000 Rand to fulfill the guarantees. So the retailer is going to be providing a provision for these refunds of 100,000 Rand. Scenario A, the reimbursement will be 100,000 Rand. Is that greater than our provision? No, it's the same value, so we can raise that as a reimbursement asset. In scenario B, an amount of 120,000 Rand is virtually certain of being received from the supplier. Can we raise a reimbursement asset of 120,000 when our provision is only 100,000? Okay, no, we cannot. Okay, so this is going to be shown in our solution. For scenario A, we said we would debit our guarantee expense of 100,000 Rand, credit the provision for 100,000 Rand, and then we're going to debit our guarantee reimbursement, an asset of 100,000 Rand, and credit our guarantee reimbursement income of 100,000 Rand. Remember when we spoke about our offsetting, we said the asset and the liability. So the debit guarantee reimbursement asset and the credit provision for guarantees liability, those must be separately disclosed on the face of the statement of financial position. We cannot offset that guarantee reimbursement and the provision for guarantees. But the income and expenses, we are allowed to set off and contra each other in the statement of profit or loss. So that guarantee expense of 100,000 Rand and the guarantee reimbursement income of 100,000 Rand, we can actually offset to nil in our statement of profit or loss. With scenario B, we said it's actually going to be the same as scenario A, because the fact that 120,000 Rand is the virtually certain value in terms of reimbursement cannot be raised. We can only raise a maximum of what the provision was. Okay, so the reimbursement asset cannot be measured at an amount that is exceeding the amount that is recognized in terms of the provision. So the provision was 100,000 Rand, which means our reimbursement value was a max 100,000 Rand. We can't recognize anything more than that. Provision reduction when paid. So when costs are paid, the related provisions are ultimately going to be reduced. We only reduce provisions paid if they were originally provided for. Okay, so ultimately, if you haven't provided for it, you're not going to be able to reduce it. And then any future loss, the liability exists independently of an entity's future actions. Okay, so if that future loss has to be there, whether or not they change their strategy, etc. So it needs to be independent of their actions. So like we had in that previous example where we said the one branch, they've got expected future losses. We said, well, you can't actually provide for that because you can still change that. You still have the ability to affect that outcome by changing strategies, providing some additional support to the branch, etc. So it must exist. So if we shut down today, would we have that liability? Would we have that obligation? Remember our walk-away test. Okay, there may be some changes in the provision or your decommissioning costs or your restoration costs, because remember, ultimately with provisions, you're using generally an estimate. So you don't have the exact figure. You don't know 100% that that is the exact amount that it's going to be. You're using an estimate. So typically that means maybe after a year or two, that estimate may change somewhat. And that is where IS 8 comes into play, where you have changes in estimates. So circumstances may change, and then the provision must ultimately change in line with those changing circumstances. There's lots of different variables that come into play within estimates, such as cash flows or discount rates that may need to be amended from time to time as the information or circumstances change. We look at it from the point of view of the cost model. So if in fact you have an increase in your estimate, you would debit your asset. Remember, you still need to test that for impairment and credit your provision, because you're increasing the provision by crediting it and you're increasing the asset by debiting it. If you in fact have a decrease in provision, you might need to debit your provision, you're decreasing it. You credit your asset, it's limited to your historical carrying amount of cost less your accumulated depreciation, and the excess value you credit to profit or loss, being the excess over the historical carrying amount. So ultimately, it can be quite confusing when you've got changes in your provision, because now there's a lot of different things taking place, a lot of movement. So it's important that you draw up some form of timeline. It just helps you to provide a starting point, see where you are and where you need to get to. Calculate your present value factors. And that's going to ultimately affect and determine how much you're going to increase or decrease your provision by. You then multiply the factors by the dismantling cost. And so you take the factors, the PV factors, multiply by the dismantling cost to get your updated present value. The difference year on year is ultimately recorded as your set of finance charges. What's important is note the date of the change, and was there in fact an increase or a decrease in the dismantling costs. That's going to affect the way your journals are processed and the values of those. Ultimately, you repeat the process each financial year and adjust the liability accordingly. Okay, so you might want to skip this part for now until you've done IS 8 and looked at your changes in estimates and come back to this. But really, we're going to go over it now for the purposes of being complete and making sure that we do cover everything that would affect this particular topic. We're going to look at example 11B. So I'm looking at part B where the dismantling costs decrease. That is one of the items that students find to be more difficult than the increase. So we have included that as being our example for illustrative purposes in this session. In this example, they told us that Susan Limited acquired a plant for 1 million Rand on the 1st of January 20x5. Depreciation is calculated using the straight line method to a nil residual value. The cost model is used to account for property, plant, and equipment. Susan Limited has a legal obligation in terms of environmental legislation to dismantle the plant at the end of its 4-year useful life. So already we can see there's a legal obligation. So we expect that there is a present obligation. They need to dismantle it in 4 years' time. So there we do have an obligating event in terms of our present obligation. There's an estimate in terms of the future cost of dismantling at 40,000 Rand. Because that value is not certain, it is estimated, we then fall within the definition of a provision. A liability of uncertain timing or amounts. There's uncertainty in terms of the amount. We've estimated it. The present value of future dismantling costs is 27,321 Rand. The discount rate of 10% is used, and the journal entries for 2005 and 2006 are required, assuming that dismantling costs decreased to 30,000 Rand at the 1st of Jan 2006. Okay, so our estimated future cost was 40,000 Rand, but it decreased to 30,000 Rand at the 1st of Jan 2006. And so when calculating our present value factors, these are typically given to you in tests or exams. So they'll say to you the present value factor on due dates is 1. 1 year before payment is due is 0,909091. 2 years before payment is due, 0,826446. 3 years before payment is due, 0,751315. And then 4 years before payment is due, 0,683013. Okay, so to get our present value factor on the very first day that we are recognizing this provision, we would use the 4 years before payment is due PV factor of 0,683013. Okay, so working out our closing liability. Okay, so we start off on the 1st of Jan 2005. 40,000 Rand is our future value in 4 years' time, times by 0,683013 gives us our liability of 27,321 Rand. We then know what will be our liability at the end of 2005. Well, it's 40,000 Rand times by the value in 3 years' time, the PV factor 4 in 3 years' time. Okay, so 0,751315 gives us our closing liability of 30,053. So how did we get from 27,000 to 30,000? Okay, so we have interest of 2,732 Rand. You could also say you took the closing liability of 27,321 Rand times by 10% gives us the interest of 2,732 Rand. And now I'm actually going to skip that red working and closing liability and work on the 1st of January 2006, because this is when the change in provision actually took place. Okay, we'll get back to that working in red, but the way you would actually complete this type of a table is you would do row 1, row 2, and then you'll skip to row 4. So the 1st of January 2006 was when we had this change. So we moved from a provision of 40,000 Rand to a provision of 30,000 Rand. Why are we using the PV factor for 3 years' time? 0.751315. Okay, so the 1 day difference between the 31st December 2005 and the 1st of January 2006, both seem to be the same, essentially. So you would still say, well, it's still 3 years left until I'm going to incur that 30,000 Rand. So we use the 3-year PV factor of 0.751315, multiplied it by our new provision value or provision estimate of 30,000 Rand, which means that at the 1st of January 2006, our liability should actually be 22,539 Rand. But what was our value just 1 day before that, 31st December 2005? It was 30,000 Rand and 30,053 Rand. Okay, so how are we going to get from 30,053 Rand at the end of 2005 to 22,539 Rand on the 1st of January 2006? Ultimately, here's our decrease. We can't say we're moving from 40,000 Rand to 30,000 Rand. Oh, we're having a 10,000 Rand decrease. No, that wouldn't be correct. Okay, so we've got to do it in terms of the PV factors. So we're moving from 30,053 Rand to 22,539 Rand, which ultimately means we have a change in our provision of 7,514 Rand, which is ultimately what we need to journalize. And we then took it one step further for 31st December 2006. We did our PV factor for in 2 years' time, 0.826446, to get our closing liability of 24,793 Rand. We then see our difference between the 1st of January 2006 of 22,539 Rand versus our closing balance at the end of December 2006 at 24,793 Rand, ultimately means interest of 2,254 Rand was incurred during 2006. We could have also said our balance at the end of Jan 2006 of 22,539 times by the interest rates of 10% gives us interest of 2,254 Rand. Now we're working on our journal entries. So to provide for our journal entries, there really was 2 elements that were made up in terms of this asset. We debited the asset cost with both the cost of the asset and the provision for dismantling, which ultimately is made up of the credit bank of 1 million Rand, that was the cost of the asset itself. And we add the credit of the provision, which is 27,321 Rand. And you'll see that as our very, very first part of that row, the closing liability. That's really the very, very first day of that provision for dismantling of 27,321 Rand. Okay, so here we can see our asset is being made up of both the cost of the asset as well as the cost of that provision on the very first day we bring in the present value. The end of December 20X5, we need to account for depreciation. That depreciation must be based on the asset cost, which includes the cost of the asset and the provision. So don't forget the provision when you are accounting for depreciation for an asset. So we take that full 1,027,321 Rand divided by 4 years to give us our depreciation for 2005. We then need to account for our finance charges. So we go back to our table, very second row. For 2005, our interest incurred was 2,732 Rand. Debit finance charges, profit and loss, 2,732 Rand, and credits our contra account being the provision, 2,732 Rand. We then reached the 1st of January 2006, and this is where we had that change in our provision from 40,000 Rand to 30,000 Rand. And we said we can't simply say debit provision 10,000 Rand. We need to account for it in terms of the present values. So we then worked it out and read there that the actual decrease was going to be 7,514 Rand. If we credit a provision to create it, how are we going to decrease it? We need to debit our provision with 7,514 Rand. And what is always our contra account when we are creating a provision? We always contra account the assets itself. So credit the assets of 7,514 Rand. Now when we work out our depreciation at the end of the December, we can't simply take the 1,027,321 Rand and divide it by 4 years. That would be incorrect. We want to work out what is our carrying amount over the remaining useful life. Okay, so our cost was 1,027,321 Rand minus what is our accumulated depreciation? Okay, so well, in 2005, we processed 256,830 Rand depreciation. So we take our cost minus our depreciation from 2005 minus the decrease in assets on the 1st of January 20x6 as a result of the decrease in provision. That gives us our carrying amount. Carrying amount over, how many years are left? We've already accounted for 1 year depreciation. So how many years left of the 4 years? There's 3 years left. So the remaining useful life is 3 years. That then gives us our depreciation for 20x6. And we must not forget that we must account for our finance charges as well for 20x6. There we see it on the very last row of our workings. 31st December 2006, the interest was 2,254 Rand. And there we have the journal entry provided. Debit our finance charges and credit our contra account being the provision liability. So it's not very difficult where you have this change in estimate or a change in the provision, but it is something we need to be aware of, and definitely you're going to cover it again as you go through IS 8 change in estimates. So when looking at these changes and estimates, we need to make sure that provisions are ultimately made for these future costs. Ultimately, we don't know exactly what those future costs are going to be. It is, in fact, an estimate, and that's going to possibly change over time. When these costs are incurred or paid for, ultimately our provision is going to be reduced. So when you pay for these costs in dismantling, you credit bank because you're paying for it, and you debit your provision. You're reducing that provision. Provision may only be reduced for the purpose for which it was originally created. So if you created a provision for dismantling, you can't say, oh, I'm going to pay lawyers' fees now. I'm going to debit the provision credit bank for lawyers' fees. Okay, it must be for what the purpose was that it was created. So if it's for dismantling costs, it must be reduced for when you pay for dismantling. Okay, looking at our next journal in our next example, shall I say, from the Gripping Gob textbook is example 13. In this example, a company recognized the provision of 350,000 Rand in respect of a court case, which was estimated at the 31st of December 20x5 as follows. Lawyer A, 250,000 Rand. Lawyer B, 100,000 Rand. During 20x6, the company attended a number of court hearings and on a few occasions received parking fines whilst outside the courthouse. The following are all court-related payments paid the 31st of August 2006. The lawyer A was paid 270,000 Rand. Lawyer B was paid 70,000 Rand, and we incurred parking fines of 10,000 Rand. The case was thrown out of court on the 30th of November, and no further payments were required. You're required to show the journal entries in both 20x5 and 20x6. So as you can see, we had raised the provision for lawyer A of 250,000, but we ended up having to pay him 270,000. So we paid him even more than our provision. Lawyer B, we had provided 100,000 Rand, but we only had to pay him less. We only had to pay him 70,000 Rand as the actual court-related costs. And then we have these dreaded parking fines as well of 10,000 Rand. So on the 31st of December 20x5, this is where we're starting off at the beginning, and we're raising our provisions of 350,000 Rand. We debit legal expenses of 350,000 Rand and credit our provision for legal expenses of 350,000 Rand. Then at the end of August, we need to pay for our lawyers. 270,000 Rand. Yeah, so we debit our provision for legal expenses. Only 250,000 Rand is what we had provided for lawyer A. So that is the maximum we can take from provision for legal expenses. We debit the additional 20,000 Rand legal expenses to profit and loss and credit bank with 270,000 Rand. We then have the second lawyer, lawyer B. So we're going to pay him 70,000 Rand, even though we provided 100,000 Rand. So debit our provision for legal expense of 70,000, credit bank with 70,000. We then have our parking fines. Remember, we can't take it off the provision because that provision was for the lawyer A and lawyer B. We cannot take off parking fines from our provision. So debit parking fines, profit and loss of 10,000, credit bank with 10,000. Then at year end, so once this is all over, or at least once the quarter's over, we no longer have a liability, but we've still got 30,000 Rand sitting in our provision for legal expenses relating to lawyer B. So because that court case is over now, there's no more expenses that are related to that provision, we're going to reverse that provision. So how did we raise it? First journal entry, we debited legal expenses, credit our provision. How are we going to remove it? We're simply going to reverse those journals, debit the provision, and credit the legal expenses with the remaining 30,000 that was sitting in that provision. And we can't keep a provision if there's no longer an obligation related to that. We then move on to contracts. So contracts, executory means that still being executed, we're still performing our duties in terms of the contract itself. Whereas what is called an onerous contract? An onerous contract means the costs of the contract are greater than the benefits that are going to be derived from the contract. Okay, so ultimately, the cost of the contract itself is actually bigger than the benefit. So we always want to, whenever we're looking at a contract or scenario, we want to ultimately decide on a cost-benefit analysis. When the costs are exceeding the benefits, it's kind of silly to still be in that contract. And that is why we call it an onerous contract. You raise a provision for onerous contract only for unavoidable costs. So unavoidable costs, if you're in a contract where the cost is exceeding the benefits, you're ultimately going to want to lose as little money as possible as a result of being in that contract. So you're going to choose to raise a provision at the lower of either the cost of just finishing that contract itself or the cost of the penalty you'll incur if you cancel that contract. Okay, so whatever's the cheaper option, that is what you're going to raise as your provision. And that is what you ultimately would execute at the end of the day in terms of this onerous contract. Let's apply this in terms of an example. So example 14 in your Gripping GOP textbook says, Cillian Limited entered into a contract to perform certain services. The total contract price is 80,000 Rand. The estimated costs of fulfilling these contractual obligations have been recently reassessed to be 140,000 Rand, but no work has been done yet. Okay, so as we can see, what will be the benefit of this contract? We're going to get a price of 80,000 Rand. That's going to be our revenue. But how much is it going to cost us to fulfill this contract? It's going to cost us 140,000 Rand. So here we can already see the cost is exceeding the benefit. So we do have an onerous contract through this scenario. We're then told a penalty of 30,000 Rand is payable if the contract is to be cancelled. You're required to process the journal entry that would be required under this onerous contract. Now, remember we said definitely we do have an onerous contract because the cost of 140,000 Rand exceeds the benefit of 80,000 Rand that we're going to make. So we said, since we do have an onerous contract, what is the principle? We must raise a provision at the lower of the cost of fulfilling the transaction or the penalty that will incur. Okay. So let's see, the onerous contract is measured at the lower of, what is the cost to cancel? The penalty will be 30,000 Rand. What would be the net cost to complete? Well, you would get 80,000 Rand, but it would cost us 140,000 Rand to make that 80,000 Rand. So ultimately, it would cost us 60,000 Rand to complete that contract. Which is lower, 60,000 Rand or 30,000 Rand? 30,000 Rand is lower, so that is the amount we're going to raise our provision at. Debit our contract costs, profit or loss. 30,000 Rand and credit our provision for the owner's contract at 30,000 Rand.